Hey, what's up, everyone? It's Josh Flores from Wall Street Saturday. I just want to thank you guys for checking out the video this week. If you can, please support the channel by liking the video and subscribing. And I just want to inform everybody that everyone on this video are not financial advisors, nor anyone's financial advisors. Anything that's said or seen on the show is strictly for educational purposes only. With that being said, please enjoy the show.
What's up, everybody? Welcome to another episode of Wall Street Saturday. Today is Saturday, February 26th. We're going to talk about some topics that we saw on the market this week. But first of all, let's get started by praying. Lord Jesus, thank you for another day that we can get together and talk about the things that we like and love. Pray that have everyone and everything. So we pray of everything, that your will be done over everything, Lord, and be with us during this time, and we give you thanks for giving us another day of life. We give you thanks in Jesus Christ's name, amen. All right, so we're gonna get started. My name is Misael Gonzalez.
I'm Josh Flores.
And I'm Joshua Trusty. So over the past week, you've saw that there's been a lot of turmoil with geopolitical issues. And one of the things we wanted to talk about today was to discuss what you can do in these very difficult and strange and unusual times in the market. So one of the first things or piece of advice that I always give to people, and if you are familiar with the show, you heard me say before, I urge you to keep the long-term view. Here is an article from Investopedia on the impact of the modern stock market as it's been affected by war. I'm going to share this. And so here's a chart from Investopedia that shows several different so-called shock events. So for example, something like Pearl Harbor, the Cuban Missile Crisis, the 100. So for example, one wouldn't expect these stocks, these indexes, to actually go up on those days. In fact, generally speaking, all of these events had a negative impact on the S&P 500. So they're going down by 0.1%, 2.3%, maybe a negative 5%, and so on and so forth. So the drawdown in total ends up being pretty substantial as well, maybe 11%. Or 13%, or even 20% for Pearl Harbor. But if you had kept the long-term view and tried to continue investing for the long term, after about a year or so, you would actually have made all of your money back and would have been well on your way to making even more money compared to the day when those geopolitical events had happened. So if you can hang on to a long-term perspective, for investing in the stock market, versus just instantly selling and then totally taking into account, basically accepting those drawdowns, you actually can stay profitable in the long term. It's just a matter of current situation, control your long-term strategy. So if your strategy is to stay the course for and have the 10-year view, I would urge you to stay long so that you can actually capture a 10-year gain rather than accepting maybe a 3-month loss. So it's much better to accept a long-term gain versus submitting to a loss that occurs for some of the things that just tend to happen in the course of an investor's time frame. One of the other things I did want to mention, in addition to that, was just let me take a quick look at my notes. Also, don't panic sell. Because if you panic sell, you're kind of thinking that you can time the market, and which is very, very difficult to do. Most investors are not able to figure out what's the exact top of the market and then what's the absolute bottom of it. But if you do stay long term into the market, you can capture those long term gains versus realizing that maybe you've made a mistake and then the market's going up without you. So that's definitely one thing you want to make sure that you're doing as you continue to invest in the market. And in addition, we'll probably have a video on this later on, but sometimes it can be advantageous to temporarily exit a position and then re-enter it after a period of 31 days. So that way you can write that loss off on your for tax purposes and actually benefit your total gains like for the next year. So we'll have like a video on that sometime later on this year on watch sales and taking a loss intentionally to benefit your gains. In addition, it might also be tempting to think about having a cash position or like selling all of your stocks and just waiting things out until until the market bottoms out, quote unquote. But this is not as technically speaking attractive as it might sound. So here's a quote from an article, and it really talks about the impact of maintaining a cash position and the exchange rate valuation. It's by Christopher Warburton, who is a professor in finance. This is what he had to say. He said that all of the major wars of the 20th and 21st centuries have been accompanied by recessions and at times stagflation. These and bloated budget deficits cause long-term economic disruptions that encourage the search for alternative forms of money and call into question the continued dominance of the dollar. War as an instrument of foreign policy endangers the vitality of the dollar, and its continued dominance under such conditions is precarious. So essentially, what he's saying is that if you maintain a cash position, things like inflation can occur, which will devalue the dollar and actually endanger your position in cash. So that means that people who are currently in cash would have an incentive to look for alternate means of maintaining their value. So you could invest in the stock market, you could say invest into say gold, and there are other ways of maintaining your value versus just totally selling everything in the stock market in staying in cash. Because as we know, we've talked extensively about the impact of inflation, and inflation itself is is a way that the dollar can weaken. So if you might have like the same numerical amount of dollars, but you're able to purchase far less with them than you were able to in the previous years. So definitely staying in cash is not a safe position when there's like when there are geopolitical issues. Thirdly, I would also mention that you want to understand your risk tolerance. So for example, you might have a position that's in aggressive growth. And if you do, you should also consider what's your time window for investing. For example, let's say you are waiting to retire like in 30 years or so. You have a lot of time to wait for maybe a position in a very aggressive growth portfolio to recover due to some short-term headwinds. However, if you're retiring maybe like next year, it probably wouldn't be advisable for you to have a position in aggressive growth, which would be subject to more volatility. So you want to make sure that your volatility and your performance is suited well to like the time window you have for investing. So don't invest more money now than you actually will need to use in the future. So if you're going to say for example, purchase a house in the next year, you don't want to be using that house money for an investment in the stock market with a very, very risky portfolio that might have good performance, but it's at the same time, it still has a pretty high standard deviation. So you want to make sure that you're minimizing risk with all the money that you really are going to need in the future. So if you need like your money really soon, consider investing in something that would be less volatile. Like for example, Ray Dalio's famous all-weather portfolio, which has a mixture of stocks, bonds, and is used to minimize a risk while getting steady gains over a longer period of time. So the current conditions in the market are very interesting to say the very least, and there isn't that much consensus amongst hedge fund managers. For example, there have been several articles out which show that Bank of America is actually bearish on the market, but other funds like BlackRock and Goldman Sachs are actually more positive and bullish on the market. So in the midterm, there's definitely some level of debate that's been occurring on the stock market as to whether or not what the midterm direction is going to be. But if you're investing for the long term, then you can just ride out these tiny waves and capture like those long-term gains. Misael, do you have any commentary on that?
I think you, brought up a lot of good points. Keeping your risk profile in check, making sure you're in it for the long term. Wartime usually is positive for the market historically. And something that I wanted to point out from the graph that you had, in terms of like the attacks that we've had that have led to war or not, is that our market at the moment is very different from the past, in that the way that we communicate is a lot more efficient than back then. For example, we have things like Twitter, we have things like Facebook, Instagram. And if you think about it, dips in the past where, were driven by fear or lack of information, or just time for information to travel, to trickle down through all the channels. Right now, we have a system that, everybody around the world can know what's going on. Everybody can understand how the prices are moving in Asia versus Europe versus the US. So something that I have been considering is that, we are going to see less of the longer drawdowns and longer recoveries. And we're going to start to see more of the quick drawdown and maybe even same day recovery, which is something that we saw last week. And that is due to the information. I mean, information asymmetry is not a thing anymore, not as much as it used to be. So we do have those quick recoveries, and it's something different. In terms of the Bank of America article, they're saying that it has been the custom to quote unquote buy the dip in recent times, particularly because the U.S. economy was strong. There was a lot of positive news on the side of startups and tech startups in that regard. But I think what they were trying to say is that we have too many fires going on at the moment. We have inflation on one side, we have the great resignation in another. We have the lack of raw material supply due to the COVID pandemic that we were just starting to get resolved as we were trying to get more stuff through China. And now you have the Ukraine war, that this is taking it to another level. It's not even in our control. It's not even in our hands. So this is something different in that if you start, if whenever pride gets in the way of business, then a lot of things start breaking down. And it looks like, some countries are already having to pick sides. I mean, China, do they want to be on U.S. side or the Russia side? India, do they want to be in the U.S. side or the Russia side? And that's something that is added in just another level of complexity that may not be good news or making buying the dip such a good opportunity as it was in the past. But those are some of my thoughts. I don't know if you guys have anything more.
Yeah, I mean, I think that there's great points from both sides there. I think that for me, the way that I'm kind of seeing it is the realities are, like you had mentioned, that inflation, the war, the supply chain. But I think from the things that I've heard from like CNBC, some of the things that I've been seeing on YouTube, I do think that the supply chain is getting better. And I think that that'll actually help reduce some of the inflation. But with that being said, with this war, it's going to hinder some of the products that we have, like the commodities, the oils, things like that. And so I think that the fear is that inflation might actually reach around 10%. I think that might be like a worst case scenario, but I think that that's just something to kind of look out for. But I think the thing that really drives the market, and you were kind of talking about information, and not just information, but misinformation as well, which I know is like a huge issue that's going on in the world right now. But I think the thing that really makes the market rocky is uncertainty, and like the not being able to know what's happening. And so I think that that's what happened this week with the S&P 500, is that we have a little bit of a better idea of what the Fed might be able to do. I think that some people are rumoring that the Fed might not hike the interest rates up 0.5%, but really more just 0.25%, because of the issues going on in the Ukraine and that implications that it might have to the supply chain. And also with that, we know that the sanctions were there, and that might hinder more, hopefully, more of the Russia economy versus the global economy. And so I know that those are the two things that came out of this week. And I think that yeah, there might be some other fires, but I personally think they're going to get a little bit better. I know that we can fight with that, right? But overall, I'm maintaining the optimistic view. I mean, again, like the Great Resignation happened, but I do think that we're going to continue to have strong jobs report. I think we're going to continue to have strong earnings report. I think that people are getting paid more than they have ever in like history, and I'm hoping that that continues, and I can see it continuing as well. And so again, I hope to continue to buy dips as they come around and continuing to go long. And that's just kind of my thing. But the last thing that I kind of want to point out was something that Josh Trusty had brought up with the sales and like the wash sales, and also another thing too, I wrote down here, sorry, let me get it to you, was the risk tolerance. And I think that those kind of things that we can talk about a little bit later on in the year as we continue to make educational videos. But that's all I kind of wanted to say about those topics.
Yeah, so obviously there's a lot going on in the market right now, but whatever you do, please, as always, stay long. You might not be green right now, but better days will come. The green is coming. Stay long.
What's up, everybody? Thanks for watching Wall Street Saturday. Remember, this is for educational purposes. We're not financial advisors. If you like our videos, go ahead and like and subscribe and hit that notification bell to be notified every time we have a new video out. Thanks for watching.